Hello, this is Brian Rezny, president of Rezny Wealth Management, bringing you an important update about the economy and the investment markets. Of course, if you're a client of our firm and you have any concerns, please call me at the office. If last week's volatility is driving you crazy, please call me at the office. Let's discuss your portfolio risk. One of the things that I do on every one of these update videos is I always explain to clients that we're going to see an 8 to 10% correction this year. Well, we just saw it. And by the way, I said this last year, the year before that. I say it every update video. The reason I do that is I want to make sure you understand that volatility is normal. It's going to happen. Now, you may have a little bit less drawdown of your portfolio if you've got a less growth-oriented portfolio, but you're not going to get rid of volatility in general. So magically, volatility doesn't disappear. So even if you bring your risk level down, you're still going to have some volatility. Maybe your portfolio didn't come down 8%, maybe it only came down 6%. But you're going to have volatility. If you get rid of all the volatility in your portfolio, you're not going to make any return. Then you'd go to the bank and you'd buy basically a CD, and today you'll be lucky if you make 1% a year. So anything that has a chance of return is going to have some sort of volatility. If the volatility is driving you crazy, again, it's all upstairs. I try to explain to every investor. It's upstairs, regardless of your age, whether you're 20 or you're 85. You could be a growth investor at 85, you could be a growth investor at 20, or you could be a conservative investor at either age. It's what you could handle emotionally. Some people handle inter-year volatility quite well. They brush it off. Other people, they don't like it. If it really is driving you crazy, we need to discuss your portfolio risk level. Let's bring down some of that volatility. It will also bring down your returns. So again, volatility comes down, your returns will come down. One of the things I want to stress is this. When you get one of these pullbacks, which happen almost every single year, and not just the equity market, mind you, because a lot of people think, well, bonds are safe. Bonds can be as volatile as the equity market from time to time. Real estate, oil, all assets have volatility. Yes, and gold can go down in a recession. So magically, there is no magic investment that you can just basically park it and say, oh, I've got it covered. I'm going to make great returns with no volatility. I'd love to tell you that was out there, but it's not going to. So ultimately, your risk profile, volatility, return. You need to really make sure those are aligned. And again, if things are driving you a little bit crazy, please call the office. Let's realign your risk profile and the model that we're tracking for your portfolio. Bring down that volatility if necessary, and let's bring down those returns. And again, stay the course. If you haven't called our office and you're not really concerned, stay the course. As I've talked about in a lot of these update videos, the economy is growing. The Fed this morning announced, which I firmly felt they would, they reduced interest rates by a full 50 basis points or 0.5%. As an insurance policy, they said the economy is growing, it looks good, but we want to put an insurance policy in place. Of course, the market rallied a little bit. I firmly believe in the next 6 to 12 months, we'll have the potential to see higher ground in quality assets if you're properly invested. But again, expect some more volatility this year. We're not going to get rid of it. In fact, this could be one of those years that's a little bit more volatile because last year we had almost no volatility at all. The year before that, more volatility. So sometimes it kind of runs year by year. Sometimes it runs every other year. You really never know when it's going to happen. I firmly believe that investors who allow us to do our job are going to be very happy people over the next 3 to 5 years. Remember, you could have a year you're down 4 or 5%. You can have a year you potentially can be up 28 or 30% like a year like last year. There's no guarantee to future results, but one thing that I've learned over managing money for 30 years, if you allow us to do our job, you stay the course, you allow us to do quality research, you allow us to stay the course, you'll be a happy camper over the next 3 to 5 years. And regardless of age, all of our clients are long-term investors. Whether you're 85 or you're 45, you're a long-term investor. Think about it this way. You've got $1 million portfolio. Are you going to spend all that $1 million in the next 3 years? Of course not. You're going to spend parts of that portfolio for income that you need for your retirement. So if you're only going to spend parts of that portfolio, if the portfolio is structured in a way that there's more conservative parts for income purposes, you can weather these short-term bouts or storms. 3 to 4 years income stream for a more conservative portfolio, maybe 5-year income stream, kind of more of a safety net if you want to be even more cautious. But if you get too cautious, your ability to make any reasonable return will be greatly diminished. And then I'll get the phone call, which I often will get from a client, Brian, the markets were up 30% last year. Do you think I should increase my portfolio risk? And what I always say to a client is this: you should be calling me when the market's down 10 or 15% and ask me at that point if you should add money and or increase your portfolio risk. What's funny is I never get callbacks from those clients after things have actually dropped to increase portfolio risk. That's when you want to do it. So again, emotions can run crazy. As you all know, last Friday I sent out an email to all of our clients and I said, go out for a nice steak dinner. Have a martini or two. That's what Brian and his wife did, and we enjoyed our night immensely. Life is short. Volatility is always going to be here, but if it is driving you crazy, give me a call at the office. Let's realign your portfolio structure so that you are a happy camper and you can sleep at night. I still see the economy good. The coronavirus, if you look at some of the statistics that we're getting now from China, the numbers are actually starting to go down. So out of the 80,000 plus people in China that have the coronavirus, half are already passed and are basically well. This is going to be nothing more than the common cold or flu. Actually, if you look at the death rate, it's actually less from the statistics that are coming out. We're not concerned, but again, hype does matter, and sometimes people look at the media, they take these things to heart, and they make emotional bad decisions. I want to thank all of our clients for your support, and as always, please call the office directly. If you'd like to talk to me, if you want me to kind of talk you through some of this and what we think. But as always, make sure you do listen to these update videos because I think they are valuable and they really give you a handle what we're thinking. And if we need to make adjustments to portfolios because of factual data that's coming in, we will do so. But we're not going to make changes based upon emotion. A client sending me some hyped up newsletter he received in his email box about the world coming to an end. We don't react to things of that nature. Research, research, and research. You've got to follow the strategy and the plan. That will allow you to be a successful long-term investor. As always, we appreciate your business, your trust. Please give us a call if you have any concerns or questions, and have yourself a safe and profitable day.